Hello everyone. It's been a while since I recorded a lesson. I've been facing a little bit of challenges here and there, but nevertheless, thank you for those that have been continuously watching my videos and subscribing. I really appreciate that, and I really, happy and glad to be back. It was just time wise that was just disturbing me. Please keep liking the videos, keep sharing so that I can be able to help the algorithm and many people can be reached out with these videos, especially high school students that doing accounting. All right, I will start with June examination past paper for 2024, and on this particular one I'll just look at question 1. Right, on question 1 the question says we'll go then right now. Right, the question says that's question 1. It says read the following instruction carefully and all that, the answer booklet, you'll have to go through that. Then the question number 1, statement of comprehensive income, notes, and statement of financial position. So basically that's income statement and balance sheet. Right, that's what basically they're talking about. Their notes. Then we have cash flow as the second question, analysis interpretation, third question. Then fourth question, audit reports and corporate governance. Right, that's basically theory. Right, we'll cover it in the following lessons. Probably take me about a week or so to cover everything, because I just have to create time. Yeah. So all right. Nevertheless, let's proceed to question 1. Right, question 1 says statement of comprehensive income, notes, and statement of financial position, that income statement and balance sheet, and some notes that you be required to prepare. Right, the common notes that normally are usually asked to prepare, it's the fixed asset note is common, the retained income note is common, the ordinary share capital note is common as well. Right, then the receivable note is common and the payable note is common. So those are the major ones that you're going to be asked one of them or two of them, depending on what the examiner is trying to test you on. Right, so the first question is that company concept. Choose the description from column B that matches a term or concept in column A. Right, write only the answer, the letter A to D. Right, directors. So directors basically, if you look at directors, let me just change this to highlight, so I can highlight. Right, so directors. So directors, an elected member of the board responsible for running the company. So these are the directors. Right, they are the elected member of the board, right, elected to run the company. So these are the directors. Right, so that's for A, so that will be C. Right, I can write basically in the answer book here. Right, so for directors we have that's C. Right, then International Financial Reporting Standards, right, that's IFRS. So these are the guidelines for the preparation of financial statements to ensure consistency, right? So that's answer D. So we can have D, right? Then independent auditors, right? Independent auditors are responsible for expressing an opinion on the financial statements of a company. So independent auditors can be called external auditors as well. So this will be responsible for expressing an opinion, right, on the financial statements of a company. And financial statements includes income statement, balance sheet, right, and the notes that accompany it as well. So those are the financial statements, right? Then shareholders, right? Shareholders are the owners of the company. So that's a B. So we said 1.13, it's A. So this one will be B, right? So that will be the answers for that. Right, then we proceed to question number 1. Right, Joy Limited. The following information relates to Joint Limited. The financial year ends on 28 February. This becomes key, right? Because most of the calculation adjustment will be based on when the year ends. Normally, it's always the last day of February, but you just have to keep watch, because they may try it, because you get used to end of February as the financial end. Then an examiner can throw a different date, a different year end. Then in your mind, you're already used to end of February. So you end up calculating everything based on end of February. Then you get low marks, not because you did the wrong thing, but you used the wrong financial year end. It says refer to C, at information C, calculate the missing amount noted 1 to 5, right? I will get there to information C. Right, calculate the information, right, denoted 1 to 5 on the fixed assets. Right, as I was saying, this is a common note that will be asked. Then 1.22, complete the statement of comprehensive income or income statement for the end at 29 February. Certain amounts have been entered in the income statement. Refer to information D, complete the ordinary share capital note. Right, ordinary share capital note, which is common as well. Right, then complete the equity and liability section of the statement of financial position. So it will not be possible for them to ask you to do the full income statement, then they ask you to do the full balance sheet. Normally they'll ask a part of the balance sheet, or they'll ask you a part of the income statement, then full balance sheet. It depends with what the examiner is planning on doing, right? But you just have to know. I always say to learners, whatever happens, there's always a question on income statement and balance sheet. So if you can master those two, right, adjustments are the same. It's always the same depreciation that we started calculating from grade 10, right? It never changes, right? You did it in grade 11, you continued 3 years doing depreciation, right? So it's disappointing if you've been doing depreciation for 3 years and still you find it very difficult to know how to calculate depreciation, right? Then information, extract of list of balances on 29 February 2024, right, which is our end balance sheet account section, right? Ordinary. Remember, they didn't say trial balance as they said list of balances, right? So this is just a list, it's not a trial balance, right? Sometimes they'll give you a trial balance, sometimes they'll give you a list of balances, right? Just have to be careful, because it becomes a little bit different how you extract information from the list of balances and from the trial balance, right? Ordinary share capital at 6,600,000, retained income 29 February 2024. This is the closing retained income that they're talking of here, right? So this is the closing, right? It's not the opening. So 29 February, that's the closing retained income. Right, then land and buildings 7,890,720, mortgage loan Citex Bank 1,609,000, vehicles 452,000, equipment 1 March. Right, so equipment 1 March, this is the opening balance. That means everything else that we're given most likely is the closing balance we'll see as we go. Right, then accumulated depreciation in vehicles 1 March. Right, that's opening balance as well. Then accumulated depreciation on equipment 1 March 2023. So where they didn't give us a date, that means it's closing. Where they give us a date, that it's opening. So that's 1 March 2023. That's when the year began and it's ending in 29 February 2024. Trading stock 1,230,000. Provision for bad debts 22,000. Creditors control 774,290. Shareholders for dividends. Right, this should be the closing balance as we'll see as we go. Right, or the declared at the end of the year. Then SARS income tax provisional payments. Right, so when it comes to SARS income tax, what happens is during the course of the year, right, there are 2 provisional payments. You pay twice, right, in the year. So you pay first half, then you pay at the end of second half, right? But then at the year end, once you've compiled your financial statements, then you calculate the actual income tax that you're supposed to pay to SARS. So you either remain with tax to be paid or tax to be refunded, receivable or payable. So depending on what was the final tax that was calculated, right, the actual, because you make provisional payments, right? Then that says income tax provisional payments 150, right? The nominal account section, right, sales 3,345,000, cost of sales 2,787,500, salaries and wages 921,268, audit fees 76,000, directors fees 1,540,000, sundry expenses 292,330, commission income 82,600, bad debts 14,100, bad debts recovered 3,260, rent income 208,250, packing material 3,700, interest on fixed deposit 27,000, ordinary share dividends 55,000. Additional information and adjustment. A credit note for 14,400 was issued on 29 February 2024. Goods returned by a customer. P. Mahlang. Goods were sold with a markup of 20% on cost price. No entry has been made. So this becomes key, right? There was no entry made, right? So they issued a credit note. Remember, a credit note is issued to a customer when they return goods to us. So we got goods that were returned that we have sold. So the credit note was for 14,400. So that is inclusive of markup. Right, it's inclusive of markup. Right, we'll see how we calculate that. Then stock on hand as per fiscal stock take on 29 February 2024. Trading stock 1,239,000. Then packing material 918. Right, a debtor Z Smith was declared insolvent. The estate paid 55 cents in the rand. An amount of 660 was received and recorded. The balance of her account must be written off. Right, so the key here, right, the way they phrase these questions, right, it says the estate paid 55 cents. It paid 55 cents, right, in the rand, right? So it paid 55 cents in the rand, right? Then an amount, so they paid 50 cents in the rand. Then this amount was received and recorded. So this was what we received out of the 55 cents in the rand and recorded, right? The balance of her account must be written off. So what was recorded is what was received, but what the balance, right, of it needs to be calculated and recorded. Right, then provision for bad debts must be adjusted to 21,220. Right, provision for bad debts. They have to be adjusted. The premises have been rented for the past 5 years, right? Common adjustment. The rent for March 2024 has been received and recorded. Due to renovation, the rent was decreased by 25% per month for only 3 months from April to June 2023. Right, we'll see how we calculate that. Right, so you just have to bear in mind that there was a reduction in rent. Right, so there was a reduction in rent. So at the end of the day, a certain amount of rent was prepaid, was received in advance. Right, that is for March 2024. Remember, our year end is 29 February 2024. Right, so see how we calculated that. So it says basically per month for 3 months from April to June 2023. So there is a period in between that the rent was reduced, right? So we'll have to calculate and see how that works out. Right, okay, then a debtor with a credit balance of 10,000 Rand is to be transferred to the creditor's ledger. Right, so that's a straight swap, right? This has nothing to do with the income statement. That's balance sheet item, right? So this has nothing to do with the income statement. That's a balance sheet item because you're just transferring a debtor, right, account to creditor's account. So basically what it means is that that particular debtor, right, overpaid the amount, or you offset what a person can be a debt and a credit at the same time. So you agree to kind of like, take their amount that they owe you, then offset against what you owe them. Right, so either they overpaid, right, or they agreed for their account to be transferred to credit. Right, the company has 3 directors earning the same monthly fee. 2 directors have been employed since 2022, and a new director was appointed on 1 September 2023. 1 director went overseas and was paid until 31 December 2023. Provide for the outstanding director's fees. Right, okay, so that's another calculation as well. Right, that's another calculation. Right, the loan statement received from ZS Bank on 29 February 2024 indicated the following. So basically this allows you to calculate the interest, right? Interest on loan, right? So you have to calculate the interest capitalized, right? Because remember the repayments, they include the interest. So whatever difference becomes the interest capitalized, right? So so that will allow you to calculate your interest capitalized, right? Remember the interest that was capitalized has to form part of your interest expense, right, or finance cost. And then there's a note: the interest and repayments of the loan will remain the same for the next financial year. So that becomes very handy when you're calculating your current liabilities, right, in terms of a loan that is maturing within the next 12 months. So you have to move a certain amount from the current liabilities into from the long-term liability in the form of long-term loan into current liabilities, right, for that particular amount that is payable within the next 12 months. Then SARS income tax 17,000 is still payable, right? If you remember this 17,000, we said in the list of balances here, right? The list of balances. If you check on the list of balances here, right, we're told that provisional tax paid was 150,000, but then if you come right at the end, right, if you come at the end, there is a note that says 17,000 is owing. So basically that means the total tax for the year was the provisional paid plus the 17,000, right? I will get there, right? Let's work on it question by question. Then it says incomplete fixed asset note and additional information. Carrying value at the beginning of the year, right? You are given for land and buildings, there is no amount, right? Then for vehicles, 416, that's at the beginning of the year. Then cost, right? There is Roman numeral 1 that we need to calculate for land and buildings. Then it's grayed out for vehicles as well, and then equipment are given as 790,000. Then movements additional at cost 150,000, right? So that additional buildings at cost. Remember, I think this comes from the question side. There were renovations that took place at one of the buildings, so I think that way that is coming from. Then disposals at carrying value, right? We're given amounts there, right? Then depreciation, so all those are movements. Then carrying value at the end of the year, right? So we're given all that, right? Then cost at the end of the year, right? We're given that as well, right? Then accumulated depreciation at the end of the year. So what we need to calculate is the number 1 to 5, right, to see how that pans out. Then land and buildings were purchased during the financial year, right? So it was actually purchases for 1,500,000. This has been properly recorded, right? Then depreciation on vehicles calculated 20% per annum on the diminishing balance method, right? The total depreciation for the financial year amounted to 83,200, right? So you need to calculate disposal, right? You need to calculate disposal. They didn't tell us how much was disposed of, but you need to calculate the disposal, what was disposed. Then on 29 February 2024, a vehicle costing 200,000 was sold for cash. Here it is, for 118,000. The business made a loss of 10,000 on the sale of the asset, right? So on 29 February 2024, a vehicle costing 200,000 was sold for cash for 118,000, right? So the business made a loss of 10,000 on the sale. So they give us everything that we need to calculate the disposal value, right? I remember disposal, we dispose of a vehicle at carrying value, right, in the fixed assets note. So you dispose it off at carrying value, not the selling price, right? So the selling price here allows us to calculate the carrying value on the date of sale or on the date of disposal. Then depreciation on equipment is calculated 15% per annum on the cost price. So that's a straight line method. The company decided to invest in a new equipment since the equipment was very old. The new equipment was bought on 1 November 2023 at a cost price at a total cost of 150,000. There is depreciation. Do yourself justice, right? Before you write your final exams, just get questions. Try and work out depreciation on every single question, right? If you do that, trust me, you get in an exam confident about calculation of depreciation. No matter which way they'll ask it, you know exactly what you need to do. Do yourself justice. Right, shares and dividends. Authorized share consists of 3 million shares. So there's authorized shares, then there will be issued shares. Right, on 1 March 2023, there were 1 million shares in issue. That means at the beginning of the year, there were 1 million shares in issue. On 1 November 2023, the company repurchased 120,000 shares at 720 each, which was 20% above the average share price. These shares do not qualify for final dividends. So sometimes if it's silent, that means they qualify, but if they state, that means they do not qualify. That's 1 November 2023. So shares were repurchased, right, for at 720 each, which was 20% above the average share price, right? So when it comes to this, the ordinary share capital note, right, you sell shares, right, or you dispose of share, or you repurchase shares at average price, right? But they were sold 720, right? So 720 was 20% above the average share price, right? So you're not going to. It was more like a straightforward question. This little complicated calculation that you need to make to get the average price, to get the what's the other one, the disposal, carrying value, a disposal, and all that. There's a little bit that you need to really right. The shares do not qualify for final dividend. 10% of unused shares on 1 March 20 were issued, right, at 6 Rand 60 per share on 22 February 2024. Right, so there was a new issue of shares, right? 10% of unused. Remember, we had 3 million shares and 1 million were in issue, and 120 were repurchased. Then still had 2 million shares that were still not used. So 10% of those were issued at 660. A final dividend 22 cents per share was declared on 29 February 2024. All shareholders on the shares register qualify for the final dividend. So 10% of unused shares on 1 March 2023 were issued. So these were issued at the beginning of the year. You just have to pay attention to dates. So they qualify for a dividend, right? So those are new issues, right? They qualify for a dividend. So because this is all shareholders on the share register, right? Remember, the ones that we repurchased, they're not on the share register. That means they don't qualify. The net asset value per share on 29 February 2024 is 620 cents, right? We'll get to that one. Right, do you still have? Okay, that's question 2. All right, let's deal with question 1. Let's deal with question 1. Right. All right, so let's start with where are we starting here? We're starting with right, vehicles, right? That's the first one, right? So if you look at here, right, you're supposed to calculate the cost price at the beginning, right? You're given the closing balance, right? Closing cost balance, and given the purchases or additions during the year. So simple, right? Closing minus additions, you get what? Your opening, right? So we have 7,890,720. So that's 7,890,720 minus 1,500,000. This will give you, let me just double check the amount. 7,890,720. 7,890,720. So this will give you 7,890,720 minus 1,500. right? So the opening balance was 6,390,720, right? So that's simple, right? So you can write your answer here, 6,390,720, right? That's your answer. Then the second one, it says so the second one, you have to calculate this disposal, right? Disposal carrying value, and this we get it from this part here. Right, these are the answers that will give you. So the business made a loss of 10,000, right? So what basically means is you make a loss on sale when you sell whatever asset you are disposing of at below carrying value on date of sale. So they made a loss of 10,000. That means they sold it 10,000 less than the book value, right? On date of sale. So to calculate that, basically we say the selling price, right? Because that's the amount that we know they sold it for, plus the loss. So that will be the disposal amount, right? So if you come here, so that will be 118,000 plus 10,000. That will give us 128,000. That will be 128,000. Or if you want, you can do it the longer way, right? Basically, if you check on this question here, right, you've got these three components, right, that will give you the answer. So at the end of the day, what was the total depreciation for the vehicle, right? So the depreciation at the end of the year, right, or on date of sale, right, you need to calculate how much was the depreciation. So basically you have the depreciation will be 200,000 minus 118,000 minus 10,000. Right, so this will give you, let me just write this clearly. So this will be 200,000 minus 118,000 minus 10,000. That's basically calculating the depreciation on date of sale, right? So that's 200,000 minus 118,000 minus 10,000. So that will give you 72,000. Right, so then that means the carrying value will be 200,000 that's the cost price of the vehicle minus total depreciation at date of sale 72,000. So that will give you the 728,000. Right, then moving on to the next part that we have to calculate, part number 3. That's carrying value at the end of the year, right? So the carrying value at the end of the year is basically carrying value at the beginning of the year, right, minus total depreciation at the beginning of the during the year, right? So that will give you the carrying value at the end of the year, right? Carrying value at the end of the year, or basically you can say cost price at the end of the year minus accumulated depreciation at the end of the year, That's the simplest that, because you're given those values here. Right, so you're given these values, right? So it becomes much easier because you have to factor in the disposed of vehicle, right? And you don't know how much was for the time that it was disposed of. If you've calculated that, it becomes, yeah, so that will be 52,000 minus 247,200. Right, so that's 452,000 right, minus 247,200. So that will give us 452,000 minus 247,200. That will be 204,000. $800. Right, we're making progress. Then number 5. So number 4, sorry, you need to calculate the depreciation, right? Then for the depreciation, what you need to have here is depreciation on equipment is straight line, right, which makes it simple. Depreciation on equipment is calculated 50% per annum on the cost price. The company decided to invest in a new equipment since the equipment was very old. The new equipment was bought on 1 November at a total cost of 150,000, right? So we have two parts of depreciation, right? So remember, there is an opening balance of depreciation. Then we have the one that was bought during the year, right? It was bought on 1 November, right? So it was bought 1 November. So you calculate depreciation for the period the asset was in use, right? So from 1 November to 29 February 2024, 1 November 2020, 29 February 2024, that's more like 5 months, no, 4 months. Yeah, so that's November, December, January, February, that's 4 months. So you calculate for 4 months. So we have 790,000, right? 790,000 and 150,000. So your depreciation will be calculated as follows, right? 790,000 times multiplied by 15%. Then we have 150,000 multiplied by 15% multiplied by 4/12, because that's November, December, January, and February. So these two give you your depreciation. So 790 by 15. Because that's a full year's depreciation. That's 118,500. Right, then 150,000 times 15% times 4 divided by 12. That's 7,500. Right, so $7,500 plus 118,500, that will give you 126,000. right? That will give you 126,000. Right. Then the problem that we have here with this, the first answer here, and this will be wrong. Right. This calculation will be correct, but then the problem that we have, if you look here, right, I've already depreciated 710,000 of this 790,000. So you cannot depreciate a vehicle or an asset to negative. So we can only depreciate up to the cost price. So the cost price is 790. So you can only depreciate it up to 790. So if 710, so if you calculate 15% of 790, that will be over. Right? You cannot have a negative asset. Remember, the policy says an asset, if it's fully depreciated, it will be left at a value of 1 rand. Right? So we need to depreciate it fully. Right? We are going to depreciate this last depreciation. We need to leave it at 1 rand. So basically, what we do on this one, I'll move this one downwards a bit. What we do on this one, right? Because 790, right, 1,000 minus the accumulated depreciation of 710,000, I will give you 80,000, and our depreciation says it's 118,500, of which you cannot record that as it is. So basically our total depreciation will be 80,000, because you cannot leave the asset at zero value. So it's 80,000 minus 1, right? So we leave the asset at 1 rand. So your total depreciation, your final depreciation will be 79,999. Right, so that you leave the asset at 1 rand. Right, so the asset will be recorded at what? 1 rand value. And then we have the 150,000 multiplied by 15%, multiplied by 4/12, right, which will give you 7,500. Right, so the total depreciation will be 7,999 plus 7,500, which will give you 87,499. Just please pay attention to that. A question may be thrown in that is like that you cannot depreciate the asset to negative. So every asset that is fully depreciated, right, you need to depreciate fully, then record it at 1 rand. So if, for instance, you have an asset that is depreciated up to almost full, then whatever amount that you depreciate, the final depreciation, it has to be kept, right, and leaving a 1 rand value, right? Okay, all right, so that will be the answer for that. Right, then the next question, right, what was the next question? Right, sales. Right, so on the sales, what we need to do is we need to say sales less, so this will be minus. If you come to our question, we add the additional notes. Right, sales, cost of sales, I've got bad debts. So what we're looking for, you're looking for the amount of goods that were returned, right? Credit note that were issued, sales returns, right? That's what we are looking for, right? So the question says right at the bottom here, it says a credit note for 14,400 was issued on 29 February, right? For goods returned by customer P. Matlang. Goods were sold with a markup of 20%, right, on cost price. No entry has been made for this transaction, so there was absolutely no entry, right? I remember when in grade 10 we have all those journals, and one of the journals deals with sales the returns, which is the data allowance journal. So this forms part of the data allowance, right? Data allowance journal, which basically record returns decrease in sales value. So on this particular one, we're going to say sales minus 14,000. It's 14,000 what? 400. Right. Then this one now, it will be cost of sales. Remember, cost of sales is the cost price of the goods that were sold, but these goods were later returned. So the cost price of the goods that were returned is in the cost of sales figure. So we need to remove that, right? How do we remove it? Right, if you see the cost price of the goods is 14,400, the sales price, selling price 14,400, but it says in this 14,400 there's 20% markup, right? So we need to calculate the 100%, because remember this is the 120%, so this is equal to 120%. So we need to calculate the 100%, right? So the 100% will get it from the 20%. So what we do here, we'll say this amount of cost of sales minus 100 over 120 multiplied by 14,400, right? It's a bit of a working, so that will give us 100 divided by 120 times 14,400. So this will give us 12,000. So the value is 12,000, right? So basically the 100 is the markup, cost is the cost price. Sorry, cost price is always 100%. Then selling price is cost price plus markup. So whichever value that you want to calculate will be at the top. It will be the numerator. So we're given the 14,500, which is the selling price, cost price plus markup. So we want to calculate the 100, the cost price. So this is how we calculate it. Right. So let's calculate and work out our gross profit there. Right. So that's 3,345,000. 3,345,000 minus 14,400. That will give you 3,330,600. I then 2,787,500 minus 12,000. That will give you 2,775,500. Right, this is in brackets, right, minus 3,330,600. So your gross profit will be 555,100. Then other income, commission, you're given rent income, right? Bad debts recovered. I was hoping they won't put it there, but they put it there. It was just straightforward because they did mention it, right? So bad debts recovered, their income. So bad debts recovered, basically it's whereby you've written off a debt as irrecoverable, or you don't expect to get paid or to recover that money, but then later on, maybe the person was insolvent, then later on, the person becomes solvent again and is able to pay his debt. Then some people, they remember who they owed, then they pay up. So that will be bad debt recovered. Right, rent, we're given something about rent here. Right, number 5, right? So we still to deal with this one too, right? And we still to deal with this one. It says the premise has been rented for the past 5 years. The rent for March 2024 has been received. That means rent received in advance. Due to renovation, the rent was decreased by 25% per month for only 3 months, right? From April to June. Right, so basically what we did, we received rent for 12 months, for 13 months, right? Because we received rent in advance for March. Our year is ending in February, so we received rent for 13 months. So how you calculate that is you do it this way, right? So for 4 months, is it April to June? That's April, May, June, right? For 3 months, the rent was less by 25%, right? Because due to renovation, the rent was decreased by 25%. Normally, it's always increased, but this time they said it was what? Decreased. So you just have to pay attention to the wording, right? So for me, I make this list simple, right? So we have 2 scenarios here, right? So we have rent, right, being 100%, multiplied by 10 months. Then we have rent being 75%, multiplied by 3 months. That is April, May, and June, right? So those 3 months, the rent was 75%, right? So basically, what we're concerned about is the rent for March, right? How much was the rent for March that we received? Right, so this will give you 1,000%. Then 75 by 3, that's 75 by 2, it's 150, that's 225. Hope I'm correct. I should be correct. That's 225. Right. So in total, you have 1,225. Right. So what we're concerned about, just we don't want to waste time. We're concerned about this figure here, the 1,000%. So what you want is how much is the 1,000%? That will be 1,000 divided by 1,225 multiplied by the rent received. We have the rent here, rent income, that's 208,250 multiplied by 208,250. Hope I'm correct. Yeah, 208,250. So all this divided by the 10 months to get the monthly rent, right? So what we have is 1,000 divided by 1,225 multiplied by 208,250 equals 170,000 divided by 10. That's 17,000. So that was the rent income before the 25% reduction. So rent was 17,000 a month. So we received this 17,000 for March. Right, remember we received rent for March. So this will be minus 17,000. And that will be minus 17,000. So that's 208,000 208,250 minus 17,000. That will give you 191,250. Right, then the student space, right? So normally there will be provision for decrease in provision for bad debts. So provision for bad debts must be adjusted to 2,220. Then if you check in our balances, right, we have provision for bad debts at 22,000. So we have decrease in provision for bad debts. In provision for bad debts, that will be 22,000 minus 21,000 with 21,220. So there was a decrease of how much? 22,000 minus 21,220. That's 780. And then we calculate our other incomes. So other incomes will be 82,000. That's 780 plus 191,250 plus 3,260 plus 82,600, which will be 277,890. Right, gross operating income, that will be gross profit plus other incomes, so that will be plus 555,100. That will give you 832,990. Right, then we move on to bad debts. Right, I think that's the open space that we need to calculate bad debts. So bad debts, if you check in our question, right, a debtor with a credit balance of 10,000 is to be transferred to credit ledger. So that's not bad debts, right, as I mentioned earlier. Then a debtor Z Smith, right, so we've addressed this one. A debtor Z Smith was declared insolvent. Easted paid 55 cents in the rand. An amount of 660 was received and recorded. The balance of a account must be written off. So basically what we have here is the 660, right? So 55 cents that was received, right, being equal to 660. And remember, that's it in every rand. That means 55 cents we received, but whatever, right, 1 rand minus 55 cents we didn't receive. So that will be 1 rand minus 0.55. It has to be written off, which is 45 cents. Right, so 45 cents has to be written off in the rand. So how do we calculate that? I remember the concept is the same, right? Whatever you need to calculate should be on the top, right? So here we're going to say 45 cents divided by 55 cents multiplied by 660, right, which gives us because this gives us the value, right? So that 45 divided by 55 multiplied by 660, so that's 540. So we need to write off 540, right? Do we have anything else? So that's minus 540. Alright, let's see if we have any other thing that is a bad debt. Right, credit note. Thought I saw something that referred to bad debts somewhere. Okay, I don't think there is. Right, then depreciation. Remember for depreciation here, 83,200. I think this was given earlier. Right, 83,200. Right, I think we have it here. Right here. Then we need to calculate this amount. Right, and basically you just add the amount, right? So when we calculated it, it was 87,499. So that will be plus 87,499. Then director's fees. Right, director's fees. If you come on the question, right, it said say last. The company has 3 directors, right, earning the same monthly fee. 2 directors have been employed since 2022, and a new director was appointed on 1 September 2023. 1 director went overseas and was paid until 31 December 2023, provide for the outstanding director's fees. Right, so basically here what we have is we don't know how much each director earns, right, but we have an amount for the directors that was paid in total. Directors fees 1,540,000. Right, so we have 1,540,000. Right, so in this 1,540,000, right, there are 2 directors that have been employed since 2022, and a new director was appointed on 1 September 2023. Right, so 1 director went overseas and was only paid until 31 December 2023, provide for the outstanding. So what we need to do for this particular one, that's the working that is easy and simple to understand, right? So 1 director was paid for 12 months, right? So we have a director that was paid for 12 months. Then we have a director that was paid for how many months? The one that was appointed on 1 September. Right, so that's September, October, November, December, January, February, right? That was paid for 6 months, right? September, October, November, December, January, February, right? Then we have another director that was paid until 31 December 2023, right? So this director was paid for 10 months. So in total, right, it's that will be 28 months that were paid, right? So the 1,540,000 represents 28 months, right? Just have to get it that way because that's the easiest way, right? You can't calculate in terms of how many months were paid, in the 1,540,000. Right, so the 1,540,000, it was represents 28 months. So we need to know how much is owing, how much was the month, because it says the director earn the same monthly fee, right? So if they earn the same, that's no issue. So if you divide this by 28, right, this will give you the amount for each director. And so that's 1,540,000 divided by 28, right, 55,000. And the other director was paid until December 2023. That means they owe the director for 2 months. So that will be times 2, right, for March, January, and February, right, which gives you 110,000 that is owed in director's fees. So for director's fees, this will be plus 110,000, right? Do you have anything outstanding? Right, let's see, stock now. Packing material. Do we have packing material there? Right, so packing material, every time be on the lookout for this one, packing material. That will be 3,700, right, minus the closing balance, which you are given in the notes, because packing material, that's 3,700 minus the packing material in hand, which is 980, right, minus 980. And then we have stock deficit, trading stock deficit, right, that will be the book value, which is 1,230,000 minus the stock take value, which we're given again, that's 1,239,000. Minus 1,239,000 plus the 12,000. I'll show you where this one is coming from. Right, remember this 12,000 here, right, this 12,000, right, that's the 12,000, right. Remember this they came back in, right, so we need to add them there. So this will give us this will conclude, so that will be 1,230,000 plus 12,000 minus 1,239,000. That will be 3,000, and then 3,700 minus 980 to 720. Then 1,540,000 plus 110,000 That's 1,650,000. Then 83,200 plus 87,499. That's 170,699. Then 14,100 minus 540, 13,560. Right, so that will be your, then gross profit. Gross profit will be total expenses that you get here. Let's just calculate them. Total expenses will be 921,268 plus 7,600, 76,000 plus 10,000 plus 292,330 plus 13,560 plus 176,99 plus 1,650 plus 2,720 plus 3,000. So that will be the loss. Yeah, it is a loss. It is a loss because this will give you $1 million. Did I calculate it correctly? No, shucks. This will be a huge loss actually, because this 1 million plus this 921, that will be way above the gross operating income. Right, maybe the reason why they just grayed out, they didn't want you to calculate that, but basically you have your total expenses here. So your total expenses, gross operating income minus total expenses, will give you your operating profit here. Right, then profit before tax, they were grayed out because they didn't want you to fill it in. Then interest expense. Right, interest expense will be calculated this way, right, because that's the only interest expense that we have. Sometimes you may have expenses from interest expense from creditors, whereby they charge you interest on what you owe. So it comes here as well, right? If you go to our question here, right, we get it from here. So the opening balance of the loan was 2,509,000. Then you made repayments of 75,000, right? So how much is supposed to be remaining? So if we say 2 million, right, minus 75,000, right, so we'll get an amount, right? So basically, if you're going to write this, right, it will be written like this: 2 million, forgot the amount, 2,509,000 minus 75,000 minus the closing balance, which is 119,000, 1,184,000. So basically what it means is if you see this amount, right, we're saying at the beginning of the year we owed 2,509,000 and we made repayments of 75,000 in total, right? So minus 75,000, right? So our loan Wait a minute, I'm missing something here. Right, sorry. So this 2 million, this 75,000, it's monthly. Right, just pay attention to that. Right, that's monthly. So you have to multiply this by 12. Right, so that will give you a total of 75,000 times 12 and 900,000. So this will be equal to 900,000. Right, so instead of 75 here, we have 900,000. Right, so when we say so what happened is at the beginning of the year we owed 2,509,000, and we made repayments of 900,000 in total, so minus 900,000. Right, so our loan amount, right, according to what we paid, is supposed to be 1,609,000. But the loan statement is saying we owe 1,984,000. So the difference between the two is the interest capitalized. So when you say what the balance is saying and what we have in our books, right, the difference will be the interest capitalized. So that will be minus 1,984,000 minus 1,609,000, right? 1,984,000. 984,000 minus 1,609,000, so that will be 375,000, and that will be 375,000. Then income tax. Right, income tax, I think I explained it earlier. If you come to the income tax, right, they said we still owe 17,000, but on the balance list, right, we paid 150,000. So the income tax, right, will be 150,000 plus 17,000. So that will be income tax. So that will be 150 plus 17,000 that we still owe because we paid 150. So this will be 167,000. Right, that will be that. Then going to ordinary share capital. Right, we come to our question here. Ordinary share capital. Right, authorized share capital consists of 3 million shares. On 1 March, there were 1 million shares in issue. Right, right, ordinary share capital is 6,600,000. Right, let's see what balance is that. Right, so that's the closing balance, 6,600,000. Right, then we say 120,000 shares repurchased. Right, remember I spoke about the repurchases. Right, the repurchases amount, where is my, scroll up to up, okay. Right, I says on 1 November 20, the company repurchased 120,000 shares at 720 each, which was 20% above the average share price. Remember I said earlier that we repurchase shares in the ordinary share capital, not right on average price. So we need to calculate the average price. So this 720 was 20% above average price. So we need to calculate the average price, right, which we're going to calculate as follows. So this is how we're going to calculate it, right? So that will be 120,000 multiplied by 100 over 120 is the same as the one I did for what do you call this, for data's allowance, right, and cost of sales, then times 720, right, because this was 20% more than the average price, so average price is 100%. So if we say 100 divided by 120, multiplied by 7.2, that will give you 6 rand, right? Then times 120,000, that will be 720. I remember this is in brackets, right? So that will be 720. So these basically were issued at 6 rand, right? Let me just change the color. So it was 6 rand per share. Right, it was 6 rand per share. Right, they will repurchase the 6 rand each in terms of the books, right? In terms of the books, then we have 10%, right? Issued 10% of the unused shares on 1 March were issued at 6 rand 60. So remember the 10% here. It's these are authorized, right? Minus the issued, so that will be 3 million minus the 1 million, then times what? 10%, right? So which is 2 million, right? So 2 million times 10%, that's 200,000, right? So they issued 200,000 more shares, right, at 6 rand 60, right? So that will be 200, right? Ordinary shares issued, right? That's the 200 multiplied by 660, right? That's 200,000 multiplied by 6.6, that's 1,320,000, right? So 1,320,000, right? So what's the opening balance? We just reverse. So the closing balance, that will be 6,600,000 minus 1,320,000 plus 720,000. I remember just reversing what we did. So the opening balance was 6 million, right? It was 6 million. Right, then equity, right? We have that retained income, right? Retained income, let's see where we get it from. Retained income, because ordinary share capital given retained income. We have the net asset value, right? This we're going to get our retained income, right, on the net asset value, right, 620 cents, right? That's where we get our retained income. So because we're given the net asset value here, right, of 620 cents per share, right? So our shares at the end of the year, I think I forgot to put that, I guess. Right, total shares that were in issue, right, that will be 1 million minus 120 plus 200,000, so that will give you 1,080,000. Right, then the question now says total net, the net asset value per share, right? So net asset value, right? Net asset on its own, that will be ordinary share capital, so is equal to ordinary share capital right, which is equal to ordinary share equity, not capital, right? Ordinary share equity right, which is equal to the total that we'll have here, right? Ordinary share equity, that will be the total. So ordinary share equity will be equal to ordinary share capital plus retained income, right? So basically what it means when say net asset, NA is equal to total assets minus total liabilities. So that will give you ordinary share equity, right? So when they say this, that's the value, right? It's 620 cents. So basically what they did, they took the ordinary share equity, right, or net assets, right, divided by the number of ordinary share, because they said per share, right? So for us to get the total equity, we're going to say 1 million and 80 multiplied by 620 or 6.2, 620 cents. Remember, when you multiply by 620, remember to divide by 100. Right, so that's 1,080,000 multiplied by 6.2. That will give you 6,696,000. So retained income will be minus 6,600,000. Right, retained income with minus 6,600,000, which is 96,000. Right, which is 96,000. Then current liabilities, mortgage loan. Remember, our mortgage loan is given. Am I going the wrong side? No, I'm right. Right, 1,984,000. Right, 1,984,000. That's 1,984,000 minus. Remember, there's this phrase here: the interest and repayments of the loan will remain the same for the year. Remember when we made that calculation for the interest, right? We said 325 is 900,000. Right, that was pay minimum as 325,000, which is the interest capitalized, right? If you look at our solution here, 375 actually, not 325, 375 capitalized. I minus 375. This will give us 525, I think. So these are the repayments that we are going to make in the next financial year, right? Because they say they will remain the same. So we're going to pay 525. Remember, we still pay 75,000 every month, right? Or it will be less, right? But a huge number of amount that will be interest capitalized, but the fixed amount that we are making repayments is 525. So we expect to pay that in the next financial year. So that gets to be moved to current liability. So this is minus 525,000. Right, so that's 1984,000 minus 525,000. That will give you 1,459,000. Right, then trade and other payables. Right, for trade and other payables, if we come to our question, right, we have let's see what we have. Right, we have this amount, right, director's fees owing outstanding, that's plus 110,000, right, plus right, this one that is being moved, right, 10,900. Right, do we have anything? Let's just double check. Right, this 17,000, right, the rent received in advance, that's income received in advance, and that's plus 17,000. Right, so this will give us our other payables. Then we have shareholders for dividends. That's 1,080,000, right, which is our balance of shares. Did I go for, yeah, which is this one, this one here, the shares at the end of the year, right, multiplied by the declared dividend of 22 cents. Where is it here? 22 cents. So that will be times 0.22. So that will give you 1,080,000 times 0.22, which is 237,000. Then we have SARS. Income tax. They said we owe 17,000. And then this value, I think that's all we have. That's 774,290 plus 17,000 plus 110,000 plus 10,900. That's 912,190. So all that gives us a total of 912 plus 237 100,000 plus 17,000, that's 1,166,190. Then this will be 1,459,000. Then total current total equity and liabilities, that will be ordinary shareholders equity, that is 6,696,000 plus non-current liabilities 1,459,000 plus current liabilities 1,166,190. So that will be 9,321,190. So that will be our question, right? I hope you find the question quite straightforward. If I've made any mistakes, please point them out. If you have any questions, please do ask. But if you have any explanation that you need any further explanation, please do ask. I'll be able to explain it to you. Right, but that will be the question. The only way I always mention that you can master this is by practice, nothing else other than practice. That's when you know where to put what and how to calculate what, right? They ask part of the questions, but you can easily get a hold of it, right? So that's the question. If I skipped anything, just let me know, or if you want me to address a particular place that you didn't understand well, please let me know. But I believe I covered everything that needs to be covered and calculated. Or if you have a better way of calculating, you can basically write in the chat, right? You can ask in the chat. I'll be able to respond. Right? I always endeavor to respond to any question. So that will be the question. I don't think I left out anything. If something was left out, is probably by mistake. I can just double check everything. I think I addressed everything, if I am right. Okay, all right, thank you for watching. Please look out for the other videos that I will post soon. Thank you so much. Wish you all the best if you are writing a matric this year, that is in 2025, your finals. I recorded this quite in July.